Hey, what's up, stock compounders? Brad here. So, I've been having a little bit of a spidey sense recently about where the markets are at. And I saw this interview just today with Jeremy Grantham. Now, Jeremy Grantham, great value investor, he's been doing this a very long time. And I really appreciated this interview. Grantham has done a lot of study of past bubbles, and I just want to share a few insights that I got from this Bloomberg interview from just a couple days ago on January 22nd with Jeremy Grantham. So, he says normally it takes a nearly perfect economy and friendly Fed behavior to produce a bubble, right? Clearly, we don't have a perfect economy right now. This one has managed to do it with a somewhat wounded economy on a global basis, right? We've got shutdowns everywhere. And to compensate for that, we've had even more spectacular Fed friendliness and government friendliness, all right? For once, we've had the joining of fiscal spending with Fed behavior, all right? The predominant belief now is that all it takes is the Fed on your side and stocks will rise forever. That feels about right. Feels like it's where we're at in this market. What are the signs we'll all look at with the clarity of hindsight and say, of course it was a bubble? That was a question posed by Eric here to Jeremy Grantham. He said the best timing for a bubble top is crazy behavior. So what is that? Jeremy Grantham points to the over-the-counter trading, okay, the OTC market. Jeremy was a big OTC trader in the speculative bubble of 1969. So we're going back more than 50 years here. This guy has been through some stuff, right? He's been through some market cycles. So he's looking at over-the-counter trading. In February of 2020, 80 million shares were traded for the month on the OTC exchange. That's 80 million in February. By the time it got to November 2020, there were 380 million shares traded, okay, in 1 month. So it kind of ramped up from 80 million in February to 380 million in November of last year. So, that's 4.5x. Now, from November to December of 2020, December 1.15 billion. Okay. So, you've got a ramping basically all year to get to like 4 times as much trading activity by November. And then all it takes is 1 month for a triple, right? 3 times as much activity. I'm going to be very curious to see what's happening in January on the OTC market. But that's one thing we can point to. Like, okay, clearly, markets are just taking off like a hockey stick in terms of activity. His own stock in a company, QuantumScape, came into the market at $10 and shot up to $130. I think just within the last couple of months, a 13x, right, in a very short period of time. That was actually acquired by a SPAC. It was reversed mergered through a SPAC to be taken public. So at that $130 per share, this company was bigger than GM or Panasonic, okay, a bigger market cap than General Motors or Panasonic. And it was 4 years away from producing its first battery, right? No sales, no profit for 4 years. And it's bigger than GM or Panasonic. So it's just insane. So some of these SPACs and other stocks are doing right now. He says it's more extreme than in 2000, more extreme than the dot-com bubble. And he talks about in 2000, the market went down 50%. I think in the first year, it dropped by half. and it only went down 50%, and then it bounced back. The reason for that is because the Fed came charging in and had room to lower interest rates, right? So let's take a quick look. This is interesting. This chart here should be loading. So this is interest rates going back. We'll see where it goes back to. Load the interactive chart. You can do it. Right, so here is 2000, right? So we're somewhere on 5.5%. So there was a little wiggle room there. We could still lower interest rates. And you can see here, this is very interesting. You look at, back to 1981, interest rates got to almost 16%. So look at how far they've come down over the last 40 years, okay? Basically from 16% down to effectively zero. I mean, what were we here? 0.5%. So, it's easy looking at this chart to understand why we've had such a great run over the last 40 years. We've had this lever to lower interest rates, to stimulate the economy. And we don't have that anymore. That lever no longer, we don't have access to that. That's done. The easy pickings of ramping rates down is behind us, is what Grantham says about that. At the lowest rates in history, you don't have a lot of levers, which is what I just said. But then he talks about the back of every bear's mind, right? Bear being, you think the market is going to go down, right, very soon. In the back of every bear's mind must surely be Japan. So what happened to Japan? In 1989, Japan managed to get to 65 times earnings, okay, for the Japanese stock market. 65 times price to earnings. It had never previously gone over 25, okay? So, frothy markets can go up much higher than we can anticipate. So, that's a big warning to anybody who's trying to short stocks. Even though clearly we're in a bubble, clearly segments of the market are very frothy, crazy behavior happening. But it can get crazier, guys. There are no laws of physics that say it can't get crazier or that it has to peak at a certain level of craziness. So, that's just one thing we have to navigate as investors. Even when things, it feels frothy, that doesn't mean you should bet on a downward trend. Doesn't necessarily mean you should pull all your money to the sidelines. These are things that make it complicated to navigate, but this is what we're dealing with today. You just don't know how long and how high a market can go if you avoid the burst of euphoria, is what Grantham said. It's the burst of euphoria that typically brings these things to an end. And we are seeing it all around us today. The euphoria is what Grantham is referring to. Going short, he was asked about Tesla. Clearly Tesla must be incredibly overvalued right now, right? So why not short Tesla? Grantham says going short is for a handful of superstar experts. You can lose multiples of your money when you go short a stock, right? You can go bankrupt. You can lose all of your money. And of course, you can't finish the game. We can't finish this game of investing, right? We can't get to the promised land if we're knocked out of the game. And that's what you expose yourself to when you short stocks. You can get margin called into bankruptcy. Do not go short individual stocks is Grantham's advice around betting that a market is going to go down. What is to stop prices from continuing to rise from here is a question posed by Eric. When you have reached this level of obvious super enthusiasm The bubble has always, without exception, broken in the next few months, not a few years. Okay, so Grantham is fairly convinced that we're going to see this thing pop within the next couple of months. But of course, there's a wild card, right? We saw what happened back in March, right? This massive injection of liquidity by the Fed into the markets. There's really nothing from stopping that from happening again. And, kicking the can down the road, so to speak. So, we can't predict when. But here's the big point. Just finishing the last few points, which are pretty critical to kind of wrap up Grantham's thought process here. The market is going to end up, as we know, where it is going to end up. And all the paper in the world will not change the level that is justified by the flow of dividends and earnings. That is, after all, the only thing you can end up eating, the flow of dividends. And sooner or later, the stock market will once again sell on the future flow of dividends, future cash flows, right? That's the name of the game here. When confidence has reached these levels, the history books are pretty clear. It's very difficult to increase your enthusiasm from a state of mild hysteria where we are today. So that's really what fuels these markets. As people get more and more excited, the market goes up and up and up because people pile more and more money into the markets. But at some point, you've reached peak euphoria, right? And that's when things start to turn. As people are getting these stimulus checks, they're getting unemployment checks, they don't have a lot to spend it on, right? Sure, they have rent, they got food, but a lot of people are living fairly frugal lifestyles these days. We're not going out, we're not traveling. It's easier to save and invest, especially with all this money being sent to us by the government. So, that could keep it going for a while. We don't know, but it's interesting to really try to wrap your head around that. Last couple points. I suspect that selling everything would work out just fine. So Eric says, are you suggesting people might consider selling all of their stocks, right? Grantham says, well, it's probably not the worst thing you can do. He's not advocating for it. I'm not doing that. I'm not, getting out of stocks at this point. But what I am doing is taking a good hard look at each of the holdings in my portfolio and asking myself, how far can this fall, right, in a crash? How much risk am I taking by owning this asset at this price? And I've, like I've said, I've gotten into a few SPACs, pretty close to net asset value, really just cash alternatives, knowing there's very minimal downside there and there's a lot of upside. We've seen what can happen with SPACs when a deal is announced. But a lot of them have gone up quite a bit since I put money in, and I find myself pulling out that initial principal. In some cases, just liquidating the position entirely to bring it back into cash. So I am taking some risk off the table. He is seeing opportunities, not so much, in the U.S., but in emerging markets, right? Overseas, particularly value stocks in emerging markets. So, that's one thing you can do if you've been riding these high flyers in your U.S. portfolio. There's plenty to look at internationally in emerging markets. That there's a lot of value out there. So that's an option. And I've seen people doing that in corner of Berkshire and Fairfax, really trimming these kind of high flyers in the U.S. and rolling them into Berkshire Hathaway or Fairfax Holdings or some of these emerging market ETFs. So That could be a very strong play right now. And then finally, the higher you bid up an asset, the lower your long-term returns. Okay, that's kind of a law of gravity in the investing arena. The higher the price of an asset, the lower your expected returns over time. And that it's kind of irrefutable. So, you know, we're seeing some very frothy asset prices today. You know, you look at QuantumScape, higher market cap than GM, not going to be selling anything until 4 years from now. That is just insane. So, you guys, I just wanted to throw this video out there because I've been getting this spidey sense that it's really time to start aggressively taking risk off the table in my portfolio. And I just wanted to share that with you guys. Really consider that. Consider doing that now. And again, that doesn't mean cash. You know, maybe you find some SPACs that you can get close to net asset value. I'm sure there's always opportunities where you've got asymmetric upside to downside. But now I think is really the time to start moving some money out of the high flyers into those safer, where you're closer to the floor. Okay, there's less room to fall. Find those opportunities. That's what I'm looking for at the moment. So anyway, guys, check out this whole talk. It's only 38 minutes long. It's really good. It's the first talk I've heard from Jeremy Grantham. And he really seems like he knows what he's talking about. There's just a lot of resonance I was getting watching this video. So I will link to this in the description. And that's all I got for today. Just a little warning, a word of caution from your friendly stock compounder. All right, guys, I'll see you in the next video. Take care.